Hey, everybody. Today is Wednesday, May 27th, and I hope this finds you well, healthy, and in good spirits. And today's talk is all about private company stock. One of the biggest challenges of private stock is that it's an illiquid but taxable asset. And a lot of people who own private company stock don't always realize that they can leverage this asset to generate cash without having to sell their shares or giving up the potential for upside. So, if you're a C-level executive or early employee with a lot of private stock and you want liquidity without having to wait for your company to go public or get acquired, this may be for you. But also, if you're a professional advisor to C-level executives or to the early employees with a lot of private stock, this may be for you as well. And I'm excited to have this conversation with Bryce Emo of Quid, who extends equity-backed non-recourse loans to employees of pre-IPO companies. And we'll talk about creative ways to get liquidity of private company stock, who it's appropriate for, and how to get it done without triggering taxes or giving up the potential for the upside. And so with that, I would like to welcome Bryce into our conversation. Hey, Bryce, how you doing?
Hi, Roman. Great to be on the show. Thanks for having me. I appreciate it.
Thank you for joining us. So listen, let's just dive right in. Right. So owners of private companies stock are often stuck with large illiquid assets. They can't touch it, right, without having one of three things happen. They can wait for their companies to go public. They can wait for those companies to be acquired, or they can sell their stock on the secondary market. But I know that you have another solution for people to consider. What is it?
Yeah. So the other option that people are just starting to become aware of is equity-backed loans.
Mm-hmm.
Loans against your private shares that are non-recourse. So if the shares go to zero, you keep the funds and pay us in stock.
So it's literally taking a loan against this private company stock that's not liquid, it's not tradable, and it's taking a loan against the value of the stock. Is that right?
That's right. Similar to a mortgage, right? So the same way that your loan is backed by the property that you live in. These loans that we're extending are only backed by the shares. It's something that hasn't been around, for all that long, but over the course of the last 3 years, you're seeing more savvy shareholders take advantage of it.
Well, take us through some of the mechanics. I mean, how does that work in practical terms?
Sure. So imagine that you have a shareholder, you as a shareholder, maybe you're a wealth advisor, you have a client who has $1 million in shares. They can receive a loan of $300,000, right? They don't pay any fees, no fees come out of pocket. So, they're charged an interest rate and some fees, but those aren't paid until a liquidity event. And so that shareholder, they've got the $300,000. They may use that to buy options. They may use it to buy a house. And then when the company goes public, they pay the company back. They pay us back.
So, all right. So then let me walk this through. So now I own a bunch of stock. It's illiquid. It's not tradable. Well, not in the open market at least. But I need some cash, right? So you're saying instead of going out and selling it at a discount, potentially on the secondary market, I get a loan. But it's only a percentage of what I own. So you said about 30%. Is that right?
That's correct. Today, given the economic climate, the general rule of thumb is about 30%.
Got it. And is that against any stock or what about options?
Sure. So a large portion of people still have options that they haven't exercised, right? Okay. And it's daunting to do so because the cost of exercising usually is somewhat reasonable, but the cost of the tax is massive. And as these companies grow very quickly and the valuations grow, it escalates quite quickly. And so, you can either take a loan out against options and purchase those and make those shares, or if you're a shareholder, you can get liquidity, for homes, for school. We have many clients doing trust planning for children, starting businesses, things like that.
Well, take us through some of these examples, because it's interesting. I mean, early on, you mentioned that this is a relatively new area. And so I imagine some folks listening to this, whether they be the C-level executives or the early employees, or maybe even professional advisors like myself, or attorneys or tax advisors, if they don't know much about it, give us some of the kind of use cases of when this might be appropriate.
Sure, absolutely. So the number one reason why people are doing this is because they hold incentive stock options, ISOs, right? The ISO has a tax advantage over an NSO, right? You get to pay what's called AMT, alternative minimum tax. In the state of California, it's about 35%. For much of the United States, you only pay federal AMT of approximately 28%. And so the name of the game for savvy shareholders who've usually been through this once before is to exercise their options as soon as possible when what's called the 409A, or the fair market value of the company, the value that the finance team places on it, while that value is nice and low, right? So that they can get that preferential tax treatment going forward. So that's the number one use case of people using these loans today. Second is, many people are leaving companies. They've got a fantastic job opportunity, or maybe they've been in a company for 4 years. Their next grant isn't that large. And so they need funds to be able to pay the tax and exercise their options so that they don't lose them. So I'd say that's the second most common reason. And then the third is, a lot of fun. People are buying, nice homes. They're taking care of their kids. They're setting up trust to make sure that, they've got some money working for their children that's been diversified, usually through a financial advisor across, multiple markets and asset classes. Many people are starting, companies. If you look at there's such a enormous field of talent at these 168 unicorn companies today. And these folks are sharing ideas, and they're coming up with new, brilliant, concepts to build. Innovation certainly at the center of that. And so people are starting businesses. We had an investor in a company, an early shareholder in their late 20s, who took out a loan of $2.1 million to start a company, and just recently was funded, and he's doing great there. We have another person who, a year ago, actually now it's 2 years ago, took out $3 million loan and opened up 20 retail locations that have done extremely well. Now of course we all have to see how COVID plays out, but there's some great use cases there. And probably my favorite is there's a shareholder, and they have about $5 million in stock, and they were driving Lyft to and from work for the past several years, just to save up money to send their kids to college. So someone out there, probably a number of people out there, have had a Lyft driver, worth millions of dollars that's driving them around. So make sure you're very nice to your Lyft and Uber drivers, because you may be asking them for a job one day.
That's so really interesting example, but yeah, you're right. I mean, if you have this illiquid asset, you're worth a lot on paper, but if you need cash and you don't have an easy way to convert the stock to cash, you're kind of stuck.
Yeah, and companies today are very restrictive with the shareholder agreements that they give their shareholders. You can't sell the stock in many cases. You can't transfer the stock in many cases. And so these loans are a fantastic way to get cash today. There's no transfer of shares. Generally, they'll use what's called a springing pledge. So the shares aren't pledged until a liquidity event. And it keeps the company happy. It puts cash in the shareholder's pocket. And most importantly, they don't miss out on the upside of the stock by selling. They get to ride that entire or a large portion of that upside as the company continues to accelerate in value.
I have a number of questions that are coming to mind, and I'm just trying to think of which direction we want to go next, because some of the key things that you've mentioned, right? I mean, they built in certain assumptions, such as, well, all right, the price of the stock or the valuation of the company, which are directly related, is anticipated of increasing or going up. Well, what
That's
if I'm this, early employee? I have a bunch of stock. I need some cash. I don't want to drive Uber or Lyft. And so I take on this loan. And then let's say the stock does not go up in price and it goes down to zero. I mean, worst case scenario. Like, what happens to me and my stock and my loan at that point?
Sure. So this is really the reason why the category was created, right? Most people, only senior level executives, founders, co-founders, people worth tens of millions of dollars in the past have been able to get loans from banks, right? And with those loans, generally there's a personal guarantee, which means if I take out a loan for $10 million, I'm the founder of a company and that company goes to being worth zero, I'm out $10 million, which I might not have. And so the category popped up because people needed to be able to take a loan and know that if the stock went to zero, that they wouldn't have to write a check to anyone. And so because these are called non-recourse loans, they're only recourse to the shares, right? So if we lend, $1 million to a shareholder, if shares that back that loan, and it might not be all of the shares, just the collateral needed, if those shares go to being worth $0, Quid or our counterparts are out the $1 million. The shareholder simply transfers the shares of stock, and that's how we deal with the repayment of the loan.
So I imagine then some underwriting has to go into the decision to which companies to lend to and which individuals. Take us through it, but before you do, I just want to mention one thing and take a quick break and to say that what we're really talking about here is the liquidity, right, of private company stock. And if somebody is watching it live now and you have any questions, feel free to ask them in the comments below. So Bryce might be able to answer your questions or get back to you at a later time. And if you're finding this helpful, whether you're watching this live or a replay, please let us know. Drop a comment below, hit like or share with those of your friends or colleagues that might find this helpful. And so with that being said, I just want to get back to Bryce and go back to the question that we had, which is, tell us about the underwriting. How do you make the decision about which companies to lend?
Sure. So, we've got an extremely talented team that does underwriting for us. I go back to there's about 168, call it unicorn companies worth over $600 billion in value today. There are some companies where this makes a lot of sense. They have a good probability, they have good businesses. The margins are nice. They're not horribly capital intensive, right? They've shown they've shown consistently good growth, 30, 40, 50, 60% growth per year. And they've got a few year outlook to going public. And so that's that's the type of companies that we at least look for. And, generally those companies are worth $500 million to $1 billion. And so that's the focus of our fund, at least. But if you're at a smaller company, there are firms that you can work with who do lend to earlier stage companies. Generally, what you'll find is earlier stage companies, the loan's going to be more expensive. There's just more uncertainty, right? But the underwriting process, we'll look at the category. We will look at the public comps. We'll look at the management team. We usually, through our network of, VCs and investors, we usually have some information on how the company's doing, so that we can make very, very good decisions.
And so now, is this decision made on the company level, or is it per individual executive or early employee that's coming to you looking to get a loan on their stock?
Smart question. So, one of the things that cause people uncertainty about a loan is, hey, how's my credit score, right? Do I have a high enough credit score to get a loan. We don't underwrite the individual, we underwrite the company. So, because the loan's only backed by the shares, we don't do diligence on the actual employee. So, if they have a low credit score because they're bad about paying their Amex bill, then they still probably qualify for a loan from us.
So it's underwritten on a company level, and if you decide to work with a particular company or lend on their stock, then effectively anyone at that company can take advantage of the program. Am I understanding that right?
Precisely. Yes, exactly right.
Got it. Okay. So, and again, the companies that you're looking for tend to be in that $500
million plus category
and above. Okay.
That's right.
All right. So
they're based in Silicon Valley, San Francisco, some in LA, some in New York for sure. And we have looked at companies in Tel Aviv as well.
So this is a really good point for us to kind of pause and ask you to tell us more about specifically what is it that Quid does, and sort of what's the ideal situation in which someone would come to you, and how do they even know if their company's participating or has a loan arrangement with your company or not, or with your fund?
Sure. So the easiest thing to do is, within 10 minutes on the phone with us or over Zoom, we can tell you a couple things. One, are you at a company that qualifies? Two, is this a good solution for you? Right. So if you are a later employee of a company and let's say the strike price on your options that you've got to exercise is over $3, probably not a fit. You usually want to have lower priced options, sub $2. We can build a model that will compare a loan to selling a stock that will help you understand which option's better for you. And what we say is, the rule of thumb is, if you are at a company and you think the company is going to appreciate in price and valuation by more than 20% in the next 2 years and another 4% every year after that, which is a low hurdle for these hypergrowth companies, you're better off with a loan than you are selling your shares. The greatest cost you have as a shareholder is the opportunity cost at a hypergrowth company, and hypergrowth companies are who we're underwriting, they're who we're targeting, and it's where we think we have a lot of value to add.
So what you're saying is people should reach out to you if they have questions, and they'll find out, A, is their company participating? B, is it, if not, the kind of company that you may want to engage in this conversation? And C, to figure out if this equity-backed loan is right for their situation.
That's exactly right. And we give a tremendous amount of free advice, right? I've mentioned this to you, but our firm, we are operators at our core. So, the founder of Troy Capital, which owns Get Quid, was the former co-founder of MySpace and has had a number of, exits. I've spent my career as both a public and private shareholder as a head of revenue, and have dealt with these same questions. Should I exercise my options? Do I do it while I'm at the company or before, and when I've left? And I've come out of pocket, hundreds of thousands of dollars to exercise and pay tax myself. So I've grappled with the same questions that many of our shareholders do. And so we really take an empathetic approach to service, which is, let us sit down with you, help us understand what your equity position is. Do you hold options? What kind are they? Do you need liquidity? How bad do you need liquidity? What's the secondary market look like? And in many cases, we'll end up leaving the conversation as friends, and it's not the right solution for you, but let me introduce you to someone else in the industry. So, our goal is to talk to every shareholder who has significant equity, and who wants to learn about what the options are that are out there. And we believe that through doing that, we'll save them a lot of time building financial models and things like that.
So what's the best way for folks to reach out to you?
Yeah, so email is always the best. You can email me at bryce@getquid.com. That's BRYCE at getquid.com. We also have a video on the site. It's about 1 minute and 15 seconds long, and it's a very easy way for financial advisors as well as shareholders to understand how the loan is structured and how it works. A good portion of the work that we do is with financial advisors, accountants, and attorneys who have been, hired by the shareholder to help them figure out what liquidity solution is the best for them. And so we're always happy to work with those folks, provide them models, walk them through the structure, and help them think through what the best opportunities might be for their clients so that they can bring them value.
And let's just stay on this for just a second, because I know that in prior conversations you had mentioned that you're looking to grow your network of professional advisors, both financial advisors, financial planners, tax accountants, and attorneys. And it sounds like if they have a client base with either executives or early employees of these private unicorn companies, they should reach out and you can help educate them a little bit more about kind of the ins and outs of the equity loan process, the technicals, and provide an option for them to consider for their clients.
100%. We have people from Merrill Lynch, Morgan Stanley, UBS, all the major banks, as well as many boutique banks like the guys at Catalyst, who are great, who reach out to us on a regular basis, right? Sometimes it's to help win clients. Sometimes it's for clients who, they've been with for a long time that they need to educate on what some of the different liquidity options are. And we really want to, be a source of education and guidance for that group of professionals. In fact, prior to COVID, we were working on with the San Francisco CFA Society on a panel on pre-liquidity planning, and we hope to bring that back once things get back to normal a bit more.
Yeah, I mean, I think that would be a great thing to do, and in part because there isn't a lot of information around this option, and even in the professional community. I mean, you and I met through an introduction from another financial planner. I think it was Aaron Rubin who had introduced us, and they do a lot of work with private stock, but not a lot of folks in the professional industry have this as an option. So it's good that you're here as a resource. I hope folks listening to this live or in a replay will reach out and learn more and see who they can help with this solution. But one of the things that you'd mentioned just a few seconds ago is that you said Merrill Lynch or Morgan Stanley often come to you. I would think that those companies have their own programs when they're making loans. Why would they sort of come to you guys?
Well, there are employees that they work with, shareholders that they work with, who might not be comfortable, with a personal guarantee on their loan. So if you think about these large banks, they generally can't do a margin loan on private stock without some sort of guarantee, right? They're not easy assets to collateralize. They're very risky assets, the eyes of a bank. And so, certainly they have fantastic and very robust lending practices to C-level executives and early shareholders and things like this. But they do come across use cases where the person needs a non-recourse loan. They want a non-recourse loan. They're just more comfortable with it. And so they bring that business, oftentimes to us to at least get our perspective on how we can add value there.
So it's if I'm not a founder or a C-level executive that is open to and willing to give a personal guarantee to get some money from my stock, I should come to you guys.
100%.
So tell us a little bit about Get Quid and how do you guys work? Who are you? I know you brought up a little bit of a background, but I'd like for you to dig in a little bit more and tell us who you guys are.
Sure. So Get Quid is really our marketing platform, right? We're owned by Troy Capital Partners out of Santa Monica, which was founded by a guy named Josh Berman, who was one of the co-founders of MySpace and had a number of exits and started a seed fund in LA, and it's done very well. And while he was participating in that, he got the opportunity to start working with SpaceX on some of their financing opportunities. And so, we are a large shareholder in SpaceX through a growth fund that we have. We're a large shareholder in Bird and a few other companies. And what we learned as we were going through that process at these companies, the tender process, was many times people wanted liquidity, but they didn't want to have to sell their shares to get it. And so we tripped upon this loan space, kind of a cottage industry of finance people and accountants, doing transaction by transaction, one-off basis. And we thought that with the right partners, we could bring tremendous credibility and scale and build a multi-billion-dollar business. And so we partnered up with Oaktree Capital, which is a $120 billion private equity company, as well as we work very closely with Ernst & Young, E&Y, because tax and equity go hand in hand. And so that merged. The launch of the fund, our liquidity fund, happened a couple of years ago, and it's been going swimmingly ever since. And then we're in the process right now of going out and raising another $300 million fund too.
And that's an interesting evolution, how a lot of things that we end up kind of doing oftentimes come as a byproduct of focusing on or starting with something completely different. But it sounds like you found there was a problem that needed to be solved, and this is one of those solutions. And how old is this industry in general, kind of this equity-backed loan space? So
people have been making non-recourse equity-backed loans for, call it, 5 years, 5 to 7 years. But it was a few players and some great firms. But we just looked at this space and thought, to put some big companies behind it who have, very efficient cost of capital, that we could bring the types of economics that were necessary to bring to the space.
So again, what would you say, if you can, to differentiate what makes GetQuid different? And why somebody would consider calling you guys versus some of these other folks? And it sounds like their space is relatively small, but why GetQuid?
So it comes down to three variables, right? It's one, service, availability of the partners, how quick they're willing to slot in and help you. Two, their ability to educate you, right? So that you feel like you're making an informed decision. And then three, it comes down to price, right? And so because of the partnerships that we have, we like to say that we'll take the Pepsi challenge with anyone on the fees and the way that we've structured them and the advantages of that structure.
That's awesome. And anything else that you want to mention that either, again, the folks in those companies that own the stock or the advisory community might want to keep in the back of their mind or move it to the forefront when it comes to working with folks that have private company stock?
Yeah, so again, we're here to help out. We would love to build models for people, walk them through the structure, help them understand how it works. Generally, keep in mind about 30% of the value of your company's stock, based on the last preferred round. 25 to 30% of that we'll be able to provide you. And I would say, get information, right? Every single shareholder is in a different situation. People have different strike prices. They have different types of options. They have different liquidity needs. And the amount of time people spend thinking about this before they do something, that can be hurtful to you. As the 409A valuation of these companies increases, don't sit on your hands, act soon. And then I'd also say, if you believe you're going to leave your company in the next 6 months, then you should be talking to someone in our space now about what the options are and how you're going to finance the exercise of your options.
That's again, good summary to wrap everything again full circle. But so it sounds like if you've got options before the valuation of the company increases, which I know happens relatively frequently at these high growth companies, is it would make sense to get some cash out to pay the tax liability and exercise at a lower price point. Right. Secondly, is if you need cash. And third is if you're looking to move or change companies, is just now beginning to think about where you're going to come up with the money to buy the stock out.
That's right. That's exactly right. Those are the three main use cases. See them, all day long. and be proactive.
And so, speaking from a professional perspective, can you help us build models? I know you mentioned you do for individuals, but can you help us oftentimes deal with the tax consequence and making sure that we're also all working as a team, really help our client ultimately make the right decision? And should we bring in an accountant into the conversation at that point?
So one of the things we as Quid do, because we thought it was of paramount importance, is we'll set you up with E&Y, because many of these fees have some tax deductibility to them, depending on how they're used. And we set up these gratis calls. E&Y has been amazing about doing them. And generally, CPAs and as shareholders, CPA will join those calls, and they always come out of them, being very appreciative and thankful that they had that conversation and helping to clear that up. There's another company that's fantastic. It's a YC company, Y Combinator, called yearend.com. They're in alpha right now, and shareholders can go on there and enter the number of options they have, what their income is, and they'll give them some idea of what their tax burden might be. So we think those guys are super sharp. And there's an entire category of companies that are coming to the industry over the course of the last year that are doing things for investors and for shareholders, like vested.com. Tom and crew over there are super sharp as well.
That's awesome. Bryce, I'm going to put your email back up just so that folks who are watching this can reach out. Any final thoughts that you want to leave our listeners with?
No, I'd say congratulations. There's so many shareholders who've amassed significant wealth. Right. The amount of wealth that has been created by tens of thousands of people over the course of the last decade is unparalleled. It's never happened before. And so, it's a very unique time, because generally a standard employee at a company would not be surrounded by a financial advisor, an accountant, a lawyer who can help them think through these things. But that's now what every one of these major shareholders needs. And so instead of servicing 5 people at the top of a company who have millions of dollars, now there might be hundreds of people at a company that need to be serviced and need to be informed. And so it's a massive undertaking. And people like yourself, Roman, are amazing shepherds through the financial world as people figure out how to provide for themselves and their family and live up to the vision they had when they started working for these companies.
Well, we're definitely up for the challenge. We're happy to have it, and we're glad to have partners like yourselves to help our clients and to help us make informed decisions and guide them in the best way. So I want to thank you for taking some time and joining us in conversation. This has been insightful. I wish you good luck as well, and I certainly hope that the professional community stays in contact, reaches out, and I hope you will be more visible as well in the community so that ultimately we can better advise and guide our clients.
I will do so. Thanks so much for having me on the show.
Thanks, Bryce. Pleasure. Be well.
Take care, buddy.
Take care.